Okay.
Hi, Paul, you can start. Thank you.
Hi, thanks, Madeline. Hello, and welcome to the Global Energy Outlook Forum 2025 from Gulf Intelligence. I'm Paul Hickin, Editor-in-Chief at Petroleum Economist, and I'm delighted to be bringing on board three excellent speakers to talk about demand in 2025. That's Marc Ostwald, Chief Economist and Global Strategist at ADM Investor Services International, Paul Horsnell, Head of Commodities Research at Standard Chartered Bank, and Maleeha Bengali, founder of MB Commodity Corner. Welcome, everyone.
Thank you.
If I can start with you, Marc, since we'll just go in the order of I introduced the three panelists, and give me your opening gambit. How do you see the demand outlook for oil in 2025? Are we out the woods in terms of China's economic weakness? Are we seeing some improvements from the European side now? And what about the US in the mix now, given that we've got obviously Trump coming on board and everything that goes with that?
Right. Well, I think we're working in a low visibility world. There are too many tensions out there, whether they're geopolitical, whether they're economic, structural ones, as they are in Europe and indeed in China. You're making grandstand sort of forecasts for the demand outlook this year is probably ill-advised, to be very, very honest. I think what one can say, this is a Europe session, so I'll start with Europe. We've got a political vacuum in France and Germany. In the UK, the government doesn't really, well, seems to be hell-bent on basically snatching defeat on every policy move that it makes. So, expecting some a more dynamic growth backdrop, which would obviously be positive for energy demand, is probably not the best thing. China, I think that there are two things here. One, the economy is definitely weak, and there is definitely a lot of deflationary forces in China simply because of the piecemeal way that the Chinese authorities have approached stimulus. The more piecemeal it is, the more that business and consumer confidence stays low, and the longer it stays low, the more difficult and the bigger, basically it's go large or go home there. But I think crucially, in terms of energy demand, particularly for hydrocarbons, what we need to keep a very close eye on in China is this not only the popularity of EVs, but also how demand for diesel is falling away simply because they are moving a lot of their freight to LNG powered trucks. And that is quite a complex demand dynamic, and it is, I think, plays a lot into why Chinese oil demand is weakening. As for the US, we know what Mr. Trump wants. We know what his Treasury Secretary wants in terms of increasing both oil and gas output. But at the end of the day, it comes down to a commercial decision from the producers. Are they going to get the sort of margins where the projects are viable over the longer run? So they can demand increases. According to the Secretary of State, he wants all the 3% growth, 3%, 3 million barrels a day extra of oil output, all well and good. if you're then creating an environment where you're throwing around tariffs the way that Trump is, not for trade purposes largely. This is probably the biggest difference from last time. We've now got let's have trade tariffs to force Denmark to give the Greenland over to the United States. I mean, that creates a very, very uncertain backdrop, and we're just going to have to live with it. It's a question, I think, for most people. It's be adaptable, be agile, and above all, strengthen those customer relationships, particularly in the growing markets in Africa and in India.
Thanks. Paul, if I can get your opening remarks on the demand outlook, are you a bit more bullish than Marc on your demand projections?
Well, I certainly agree with Mark that there's a lot of macro uncertainty which you have to overlay on top of everything. But to start on the macro side, I mean, we're not looking for a world which is going particularly fast, but we're also not looking for particularly gloomy economic projections. And just to run through the Standard Chartered the key numbers, I mean, we expect China to grow about 4.3% this year and then 4.1% in 26. For the euro area, speeding up a little from 0.8 this year to 1.2% next year. But remember, the income elasticity of oil demand in the EU is very, very low compared to other areas. So you could have a very large increase in growth or a big decline. It's not going to make as much impact as it does elsewhere in the world, but generally not falling away, not as bleak an outlook, I think, as many are concerned about in Europe. India just continuing 6.5% growth, 25 and 26, and then the US speeding up a bit, but there's some upside risk, I think, on the US depending on the amount of inflationary policies and stimulus that comes through. Sort of 1.8% GDP growth this year, going up to 2.1. When we look at that in demand numbers, it comes out pretty much like a par year. So for this year, just over 1.31 million barrels a day of growth, a bit more on our numbers than 24, and then about 1.23 for next year. So there's some interesting things going on in the composition of that, but the overall impact is pretty much what you would expect, somewhere around about 1.2% growth, which, given those macro numbers, implies these kind of elasticities of whereby India is going to be doing quite a lot of work with that 6.5% growth. So just to finish on that sort of highline numbers, we think India is the main source of incremental growth in both 25 and 26, growing, without being too precise on it, just over 300,000 this year, just under 300,000 next year. China coming in about 2% demand growth, which, again, it's a mature demand economy, and the US also chipping in with 170, 160. So it's coming from different places. But just to finish on this item, I just want to make a point on, because it's very tempting to see everything in China terms, that China's the main engine of growth and there won't be any demand growth out of China. I mean, I look back on the numbers back to 2005, which is a deliberately chosen year because it was when OECD demand reached its peak. So since 2005, so 20 years ago, OECD demand peaked, and it's fallen about 4 million barrels since. Since that point, non-OECD demand has increased by 24 million barrels a day over those 20 years, and China's provided just under 10 of those 24. So I think there's a danger in focusing too much on the 10 million barrels a day growth over the past 20 years and forgetting that most non-OECD growth has come from other countries, and that represents the full 14 million. So compositional effects, so I wouldn't say massively different from Marc. It's not a gangbuster strong story, but it's also not a story of weakness. I mean, for us, the main story of this is going to be on the supply side, and the crushing disappointments people are going to have when non-OPEC supply growth disappoints yet again.
Good point. And Maleeha, can I get your thoughts? Where do you stand on demand outlook for 2025 generally?
Thank you, Paul. I think the big really is, to follow on from Mark and Paul, is whether or not you believe in a recession in the US, right? The big determining factor for 2024 was the US managed to somehow escape a recession, soft landing, no landing, whatever have you. And the big debate out there from the macroeconomic world is, has the US just avoided the inevitable, but eventually the recession is going to hit? That's a huge debate one way or the other. Going back a second, I think like this year will be all about macroeconomic data. I think China has seen a massive secular shift in demand, as Mark talked about. So I won't go over again. Europe is in doldrums. And India, yes, there's a lot of growth coming from India and these countries, but the rate of change may be high, but the absolute numbers are still dominated by Chinese demand, right? All of last year, OPEC and IEA got their Chinese demand numbers wrong, right? They kept deteriorating, then take them lower and lower. The main thing is just a 1% change in China, the rate of change can change that global balance. So we still need to focus on what China is doing. Now, talk about China. There's a massive macro imbalance going on right now. We've talked about the property debt bubble. The yuan is in a massive free fall right now against the dollar. Chinese bond yields are actually dropping versus the opposite of US bond yields that are rising. So there's something happening in the currency market and bond markets, and I think we'll get an answer in the next few weeks, if not month, after Trump is elected, because that's going to determine what's going to happen to demand and the global economy. So I think those drivers are more important rather than talking about specific countries, because it'll be a very macro-led market. The US debt issue is a massive issue. Like the more and more bond yields go above that 5% magical number, we could trigger a recession, right? Because equity markets have been weak for the last month on back of that. So I think Trump policies, tariffs, inflation, Fed policy, that's going to determine dollar direction, and then eventually we'll see demand. I think that's something that we are looking at very, very closely for 2025.
Yeah, that's a good point, Maleeha. And I want to pick up on that, some of the points you've raised actually, and throw that back over to Mark and Paul, which is, there is a real risk here. You've got risks of recession. You've sort of centered where the central view is, but there are these risks of recession still going on in the US. There are still this sort of deflationary risk spiral in China, and you've got a potential risk around a trade war, the negative effect of potential sanctions. Mark, if I can get your thoughts on that kind of, because China and US here, I know we don't want to focus purely on those, but as the two heavyweights here and the two probably big risk factors, and that they might butt heads in 2025. How do you see that playing out?
Well, I think in terms of the US, the most important thing to really, try and get one's head around. Well, you can't second guess Donald Trump or Elon Musk or anybody else. The problem is sequencing of what is implemented. What's he going to do first? Where are the tariffs going to be imposed first? Who's he going to impose those on? Then the other two key aspects are how divided is the Republican Party on terms of extending the Trump tax cuts, and indeed that, and how quickly will Trump implement these immigration limitation policies. That latter one is very important because that is what's been driving US productivity and driving a lot of US growth over the past couple of years. And also, obviously, what happens to the Inflation Reduction Act. A lot of it will be preserved because it benefits Republican senators and congressmen. But it's, then how he butts heads with China, there's all sorts of mixed messaging going on. To me, there is a recession risk in the US, and it's very much driven by what he does domestically rather than in terms of tariffs. The tariff part is more how it disrupts supply chains. But I think the one lesson over the last 3 to 4 years, COVID followed by the Russian invasion of Ukraine, is the commodity and energy markets are very, very creative. If there's a supply disruption, I very much doubt it's going to be anything more than, yes, we'll get spiky reactions like we got to the war in Gaza. And then suddenly it fades away because people go back to, well, what is the overall supply demand outlook, particularly in energy? But increasingly, I think that there are other aspects in terms of, for instance, aviation demand. How quickly are we going to move to greater use of sustainable aviation fuel? It's still very low. The scale of it is output is so tiny, but these things can speed up at great speed. So there are a lot of complex variables. The recession risk is definitely there, but it's really much more in terms of what the US does domestically and how that imparts, changes to demand from the US for imports from the rest of the world, regardless of geography. And one final point on that, in terms of tariffs, one should remember that if they basically imposed lots of tariffs on China or indeed on the EU or whoever they're going to play, basically there's going to be a lot of production which still needs to find a home and may end up being dumped elsewhere. Europe looks particularly vulnerable to that sort of dumping from China, from Canada, from Mexico, from South America.
I want to also, Paul, before I bring you in, and I want to just take that point of one of Mark's points and maybe just add another layer of complexity and question to it, which is that with the risk of sanctions, with tariffs, something Mark didn't sort of mention as much, which was the sort of knock-on effect of costs and how that can play into inflationary environments and how that can, and how, if you talk about Mexico and Canada with the sort of potential rise of crude imports, or the general knock-on effect to actually manufacturing industrial side, both in a position on US and internationally. How do you see the inflation side as well impacting demand, and obviously, maybe keeping interest rates higher for longer? What's your thoughts there?
Yeah,
Well, I think.
Oh, sorry, Mark, go ahead.
No. Go on.
No, all I was going to say is, well, yes, agree. I mean, there certainly are inflationary risks, and you think most markets are pricing in higher inflation than they did 3 or 4 months ago. That's right the way, really, across asset classes. But that's, again, is one of the things I think we have to look at on both the supply side and the demand side. And particularly on some of the US shale numbers, obviously, there is a sensitivity there to inflation, particularly on steel, which tends to get caught up in this. Generally, those cost pressures have accelerated over the course of the past 6 months or so. And I think it's just a concern that it introduces that extra dynamic.
Maleeha, what's your thoughts? You're quite almost, I'm gonna say downbeat on the US, but you certainly highlighted some big risks there. And how much is inflation such a part of this sort of? On one side, you've got this inflationary risk still that continues, and interest rates stay higher in the US side, and on this other side, like China, you've got this kind of deflationary spiral that they can't seem to, which Mark highlighted, which you can't seem to sort of get out of. How do you see these two sort of contrasting difficulties, shall we say?
Okay, so it's basically the US, the Fed actually has a two-tier problem. On the one hand, they had the fastest rate rising campaign in 2022 and 23, where the rate raised by north of 450 basis points. We all thought that would break the economy, but it didn't because of all the liquidity injections. Now, having said that, the Fed needs to lower rates because their interest expense is north of $1 trillion. The banks and consumers need lower mortgage rates, and they need to boost the economy that way. But they cannot cut too fast because inflation is still, your core CPI is about 3.3%. So they're really stuck between a rock and a hard place. They're looking for any sort of ammunition justification to lower rates because the economy needs it, but at the same time, they can't, right? So this word that we talk about, stagflation, very risky, scary word, we may be seeing economic data slowing down. And we've spoken about this at length. The US economy has just been egged on by more and more liquidity, right? Every time there's a crisis, the Fed steps in, they pump liquidity in. We thought 22, 23, all the regional bank crisis, the amount of liquidity in the system has been ample. The question is, can AI and can technology and productivity grow fast enough to compensate that debt? Now, we're in a very precarious situation where the debt is massive. The Fed has to probably issue more, or, to soak up the treasury supply, but the US productivity needs a bit more, liquidity. So that's where we can see this sort of chances of recession, because I believe in the AI and technological revolution, but near term, companies have spent massively on CapEx and AI, but the productivity numbers are nowhere close to what people are pricing in. So the question now is, the higher for longer interest rates are breaking the economy, right? It's forget the large 7 or 8 stocks. Everything else is suffering. Look at the small cap stocks, mid cap stocks. And I think that's the window of uncertainty given higher for longer rates, higher for longer sticky inflation. And the Fed needs to cut right now to see if the banking sector forget inflation. We're going to go north of 5-7% again, right? So this is a very tricky situation. But one thing that's really important is in our generation, nobody's ever traded stagflation. We've always had a very deflationary economy for the last 15 years, and markets have been going up, and now we have debt at post-World War II highs. The question is, what's next? And I know people talk about the debt bubble, collapsing, but we could probably have another few years left. But let's think about the big picture. And I think macroeconomics is what's going to break the market this year, and it's going to demand. If 5% what gets to and chokes the economy, it's going to hit everybody, right? So I think that's what's important. And what does the Fed do? How do they combat it? But there's only one answer: more fiat currency debasement. And that's why when you think about asset allocation, it's very interesting how you do not want to be investing in equities or bonds. There are other sort of opportunities. And I think investors are now starting to think about that rather than just blindly putting money in S&P and NASDAQ and those large stocks, which may just hold up here. But then you need to think about the last decade, right? Equity could be flat for a long time with very sort of choppy, volatile trading. So how do you as an investor allocate your capital? But then going back to Mark's question, we have so many macro, landmines to go through before we even get there.
No, thanks, Maleeha. I want to move slightly more granular and look a bit more deeper now into the actual oil demand specifics. And Paul, you mentioned the changing composition of oil demand, or you made some references to that. Where do you see the drivers for oil demand in terms of the product specifically? Are we on a set course for petchems being the huge driver and the continued growth in petrochemicals? And how Mark mentioned a bit about jet fuel and aviation demand being still we've got that playing off against sort of the idea of renewables making inroads, but are they really making inroads, or is this a story about energy or oil addition, or oil and energy substitution in a way? Is this a replacement story, or is this an added story? Because even the arguments of EVs, for example, I've been reading things like people have been buying EVs as a second car rather than as a replacement car. So, and I don't know how, I know it depends in certain regions, and obviously still EVs are quite a middle class still purchase. So what's your thoughts on actually oil demand composition, how that's changing and how it's driving demand?
Yeah, I think those sort of those changes probably don't reveal themselves on a year-to-year basis very well, but they certainly come in when we start looking towards demand towards the back end of the decade. And there, I think you're generally right. So we would expect petchems to have a growing share within China, which has spoken about before. Yes, the growth is going to come mainly from jet fuel and from petchems. Less from transport fuels, but I very much agree with what Neil Atkinson said in the previous session, that that doesn't mean it's going to fall. It just means that some of the incremental growth from transport demand is going into those. So it's all fairly slow. I think if we take it market by market, generally the take-up rates of EUs in developed markets is disappointing. It's sort of running behind target, and there have been a few sort of obstacles along the way, whereas the take-up rate in China is obviously accelerating, but starting to hit those kind of limits. In short, yes, it matters, but on that sort of 1 year view, no, it's not going to make a huge difference, but it makes us feel that oil demand does continue to grow right the way out to 2030. So we would push back a bit on the eventual peak in total oil demand for the end of the decade. I think it plateaus for quite a long time and pushes back the actual peak into the next decade.
Mark, if I can, ask you to lead on from that question, before we just jump on. Before we jump onto the survey question, well, if people can have a look and vote on the survey. But Mark, if I can ask you about the idea, because you mentioned EVs as well, and how much specifically maybe in China, and how much is EVs, the EV, as a result of causing oil demand weakness, growth, or oil demand growth weakness, or potential peaking in oil demand growth and gasoline growth. How much is that a story of EVs, and how much is that a story of China's general economic weakness? It seems sometimes people conflate the sort of near term and the sort of medium term risks here, and or how much are they sort of blending into each other?
I think blending into each other is definitely the right expression for that. I think there's an important point to make here, because when we're talking about hydrocarbons, we never talk about coal anymore, and yet coal usage, particularly in the power sector, is still growing. So for those pronouncing the end of oil demand, or indeed gas, which is obviously not going to happen anytime soon, be careful, because we transitioned away from coal a long, long time ago. So in terms of China, yes, China is this sort of counterfactual, I think, in terms of EV. It is, in part because it's so far ahead of everybody else, in part because EVs are far more affordable in China. I mean, this is the big issue. Look how badly EVs are failing in a country like Brazil, but hybrids are doing really, really well. And it's all about the affordability of the vehicle. Forget, the actual, powering of the vehicle. And those are the sort of big nuances. So China EV demand will basically weigh on petrol demand. There's no question about it. Just as the transition to LNG powered trucks will make a difference. Does it make a big picture difference in the rest of the world? Well, for a lot of the developing world, if we're saying basically India and Africa are going to be the big driver of oil demand, anything to do with the energy transition, that they have a developmental need, which basically rides roughshod over any nuanced changes in, is this more environmentally friendly, or is this less environmentally friendly? They need everything. I think Narendra made that point about India, both today and the Energy Forum last year. So, to my way of thinking, people shouldn't basically. I think there's a great risk of people grandstanding about where demand, how demand's going to change. It is going to be far more nuanced. I don't think, with Europe where it is, you've got the EV demand proving to be spectacularly poor, and it's largely because for instance, the German and French car makers, as the biggest ones, aren't making vehicles which are affordable for the average man in the street, and hence the uptake is not good. And you look at the other side, on the power side, people talking about, oh great, we've got all this wind power, but at the end of the day, we haven't got the distribution networks, all the grids basically to handle all the extra electric power demand that we're going to need. So there's a lot of stop-starting going to go on here, and it makes the overall outlook for take-up, both of hydrocarbons and of environmentally friendly power sources, really, really very, very complex. But I think the most important thing is everything's still growing. We're not getting the sort of hiatus that is actually going, I think that point was very well made by Paul earlier.
Yeah, if we can bring up the survey responses, hopefully all the panelists have you all added to your given your views. Yeah, and obviously it seems like India and Africa seems to be the areas where are carrying a lot of the burden, carrying the weight, and obviously petrochemicals, and even China's got some boats. Maleeha, if I can ask you to comment on that, and also especially to follow up on some points that Marc and Paul have made about India and Africa as being some of these important growth drivers. It's not just about China, or that actually India and Africa, and how much risk is there attached to assuming that India and Africa can carry this weight, and the kind of ROW, the rest of the world, sort of as takes over a little bit more of the mantle from China. Well, was still a big part in the past, but it could even take further part of the share here. What's your take here, Maleeha?
Sure. Just on the poll, my answer to that poll was number 3, China, because obviously near term. So we have two scenarios, the near term market and the long term market. I do think the near term China will probably play a lot heavier role in terms of determining the demand supply balance based on near term. But longer term, you're right, secular shifts in Indian demand, Africa, those things will come into play on the back end, oil prices. So it's a bit hard to sort of talk about that, but we definitely agree with that. But the next 6 months to 1 year, perhaps even 2 years, will depend on what we see in OECD, on China and these sort of countries, like I spoke about earlier. The other thing I know we don't have to talk about right now is OPEC supply. We know the thing about oil markets, our mantra has been all along, there is no shortage. So even if you tweak our demand numbers up and down across the board, there has to be a significant shift in, we're going back to China, going back to 2008 to 2010 to see a massive dent in the oil market because there's so much spare capacity sitting there. So the oil price could just be in a range where you have this sort of supply and demand factors moving. What is going to change that needle? And I think near term, if China does manage to come up with some sort of a stimulus bazooka program of 20 trillion or some ridiculous number, it's a very different ball game scenario, right? So I think we need to separate the near term and the long term, but I think near term China is probably a bit more important than Indian and African demand. But long term, of course, we need to think about EV adoption, infrastructure, all that stuff will be in longer term.
Thank you, Maleeha. I think that will be, you have the last word, Maleeha Bengali. Thank you very much, Maleeha Bengali, founder of MD Commodity Corner. Thanks to Paul Horsnell, Head of Commodities Research at Standard Chartered Bank. And thank you to Marc Ostwald, Chief Economist and Global Strategist at ADM Investor Services International. Thank you very much, all three of you, for I could talk all day with you guys. Thanks very much.
Thank you, Paul.
Thank you.
Thank you.